The market is not a battlefield of random chaos. It's a perfectly choreographed illusion. Every fall, every bounce, every panic wave, they're not mistakes. They're signals, designed, timed, executed by those who understand that survival in this game isn't about avoiding losses, it's about using them like weapons. This is the smart money survival strategy. The art of controlled risk, disguised as weakness, to lure retail confidence straight into a trap. Let's start with what retail traders never grasp. Smart money doesn't try to win every trade. They try to win the game. Every small loss you see them take is a calculated decoy, a chess move, not a defeat. You see, the moment a big player enters a position, the market reacts. Liquidity dries up. Price moves too soon. Everyone notices. So, instead of showing strength, they simulate weakness. They build narratives. They let the charts pretend they're losing. Imagine this. A stock starts dropping sharply. Social media explodes. Traders scream, "Big money is exiting." But behind the scenes, the same institutions are quietly absorbing liquidity, buying every panic sell. They allow the fear to build because that's when volume floods in. They need your emotion to fill their position. So, while you're reacting to red candles, they're building the foundation for their next profit cycle. This is controlled risk. They risk small portions of capital publicly, positions that look like mistakes. But in reality, those positions are tools. Every loss is a decoy, a smokescreen hiding a much larger intention. Smart money understands something retail never will. Visibility is vulnerability. If the market can see your strength, it can counter you. But if it believes you're weak, it lets you move freely. You've seen it countless times. A breakout fails, stops get hit, panic floods the chat rooms. And then, without warning, the price reverses, moving violently in the opposite direction. Retail traders cry manipulation. They scream, "Stop hunting." But what actually happened is that smart money created space. They used a fake move to force out weak hands, then loaded up quietly once the noise settled. Controlled risk isn't just financial. It's psychological. It's the willingness to look wrong temporarily, knowing the long-term payoff is enormous. It's the courage to accept pain strategically, not emotionally. When retail traders take a loss, they panic. When institutions take a loss, they smirk, because it was part of the design. Let's break down a real-world example. In 2020, when markets crashed overnight, retail traders dumped everything. But institutions didn't panic. They absorbed. They played the long game, creating the illusion of collapse while quietly accumulating. The result? Within months, markets reached new highs. The losses they appeared to take were just camouflage, controlled burns that cleared the path for their real strategy. Smart money thrives on probability, not perfection. They know risk can't be avoided, but it can be engineered. They diversify their losses, spread exposure, and structure every trade as part of a system, not an isolated bet. Each position communicates with the next, balancing outcomes like gears in a machine. That's why even when they lose, their system survives. Because it's not about being right, it's about staying alive long enough to win. Now compare that to the average retail trader. Every trade feels like a final exam. One stop-loss hit and they spiral emotionally. They increase lot size to recover. They jump to new strategies. They chase certainty. Something smart money knows doesn't exist. Smart money doesn't chase certainty. They manufacture asymmetry, setups where potential gain massively outweighs potential loss. When you hear institutional buying zones, you're looking at the aftermath of that asymmetric planning. Those zones are created after liquidity has been hunted, after emotions have been harvested. Retail calls it market manipulation. Institutions call it inventory management. Controlled risk also means strategic surrender. Sometimes, smart money deliberately loses small battles to win wars. They'll let a price fall below support, trigger panic selling, then re-enter when the crowd is exhausted. It's like pushing the enemy into a trap by pretending to retreat. The crowd only sees the fall. They never see the hand pulling the strings. If you watch closely, you'll notice a pattern. Markets often show weakness before a major move up and strength before a major collapse. It's not random, it's deliberate inversion. Smart money knows human psychology can't resist patterns. If a setup looks too obvious, they flip it. When everyone's buying the breakout, they're selling into it. When everyone's panicking, they're accumulating quietly. And the irony? Retail traders unknowingly assist them. Every stop loss you place near a logical level becomes liquidity, a magnet for smart money. They don't need to guess your position. The chart tells them. The crowd behaves predictably. Every trader thinks they're unique, but when emotions drive behavior, uniqueness disappears. The herd becomes algorithmically traceable. Smart money's greatest weapon isn't money. It's time. They wait. They let retail traders burn themselves out with impatience. Every impulsive trade, every revenge entry, every FOMO buy, it adds fuel to the narrative. They know patience is invisible power, and they know that by appearing weak, they invite greed. Because greed blinds you faster than fear. When you see institutions taking losses, your mind relaxes. You think you're safe. You think the big players are suffering too. That's when they strike. When you drop your guard, convinced the worst is over. The illusion of safety becomes the setup for your destruction. So what can you do to protect yourself? First, stop reacting to surface-level movements. The market isn't what it looks like. It's what it implies. A red candle doesn't always mean selling, and a green candle doesn't always mean buying. Look for context, volume shifts, liquidity zones, market sentiment, and the timing of moves. Second, reframe losses. Don't treat them as failures. Treat them as controlled risk. The same mindset that institutions use. Limit your exposure, manage your leverage, and let statistics, not emotions, guide your decisions. Third, stop assuming transparency. Every visible move is part of an invisible game. What looks like weakness may be bait. What looks like strength may be liquidation. Learn to question the obvious. Fourth, design a system that survives chaos. Survival is the foundation of success. You can't control volatility, but you can control how much of yourself you lose to it, financially and emotionally. Because in this market, survival is victory. Every trader falls. The difference is who gets back up with data, not trauma. Smart money's power doesn't come from predicting the future. It comes from controlling the present. By mastering patience, managing risk, and accepting short-term pain, they position themselves to win long-term games. They don't react. They anticipate. They don't chase. They attract. The next time you see a weak market move, ask yourself, who benefits from this illusion? Who's absorbing the fear and who's manufacturing it? The smart money survival strategy isn't about never losing. It's about losing smartly, about turning risk into camouflage, about playing dumb to play free. Because sometimes, the greatest strength is pretending to be weak, long enough for everyone else to expose their hand. If this opened your eyes, hit like, comment your thoughts, and subscribe for more deep breakdowns of market psychology, manipulation tactics, and trading mindset secrets. Watch the other videos in this series to uncover the hidden architecture of the financial world.